chairs are just sitting on right now.
Hello, everyone, and welcome to One Chair. A bit of a different format today. I want to debunk some misconceptions around MSTR and strategies specifically around their preferred shares. And there's an interesting article that I found on LinkedIn that really shows a negative bias on strategy. And while some points I agree with, most of them are actually not researched really thoroughly, and I'll be able to debunk most of what is said there. And so this is what we're going to do right now. So I'll flash up this post and go through it line by line and give you my opinion about it. So starting, so here, flashing it up. Anton Golub has written this post. He's a chief business officer of crypto and Web3 companies. So he is in the crypto space, and so I assume has some understanding of Bitcoin, but is very critical of Michael Saylor and what strategy is doing. So let me read this post to you. It starts with Michael Saylor put an actual pyramid in his pitch deck. No irony, no shame. Saylor is pitching another yield product backed by nothing but hopium. So what he's referring to here is this pyramid here that I'll flash up here quickly is basically the capital structure of strategy where we see all of the preferred shares where they stand in the capital stack and backed by the Bitcoin and the MSTR equity at the bottom. And what he's alluding to here is basically that it's a pyramid scheme. Now he's going to talk about the new preferred equity that was just announced this week, Stretch. So let's get into it. First, Stretch is the fourth perpetual high-yield stock issued by Strategy. It pays a 9% annual yield, but Bitcoin yields nothing. Okay, so here it's true that it will start at this 9% annual yield, and Bitcoin yields nothing is true in Bitcoin terms. But if you look at it in dollar terms, I mean, Bitcoin has been appreciating with an average rate of return, an ARR of over 30%, actually over 50% throughout its history. And so it's a bit much to say that Bitcoin yields nothing, right? If you hold Bitcoin and you hold it over a long enough period of time, it will appreciate in value against the dollar, and those annual yields are paid in dollars. And this is basically the whole premise of what Strategy is doing, right? They want to accumulate Bitcoin, and they think that Bitcoin will appreciate in value a lot faster and higher than any of those annual dividend payments that they need to make, right? And while technically it's true that Bitcoin itself yields nothing in Bitcoin terms, it does have a pretty high IRR compared to the dollar, and this is why they are able to pay those dividends over a long enough period of time. Bitcoin will go up a lot more than those 9%. So that's my opinion on that. Then Saylor will adjust dividends monthly to keep it trading near $100. Yeah, this is factually true. This is basically the way they set up this fourth preferred share, is to have a stable price of $100 while moving or adapting the dividend. So factually true. Compounds unpaid dividends, true as well. So if they decide not to pay dividends at a certain point, they will have to pay back later. It compounds. The trade only works if Bitcoin goes up. No, that's not true. If you think Bitcoin goes down forever, then at some point the trade will not work anymore. That is true. If you think Bitcoin goes up, it works. If you think Bitcoin stays flat, it works. If you think Bitcoin goes down a lot and then comes back up at a certain point in the next 10 to 15 years, it also works. So I don't know what is meant by that. And otherwise, severe losses, Saylor admits. So I don't know. I've seen the whole presentation of Stretch, and at no point Saylor says that there are potential severe losses that you could have. So I'm not sure what he's referring to here. If anybody knows and has a video or a comment by Saylor saying severe losses, let me know here in the comment section. Would be good to get some more info here. He literally told investors the plan: if Bitcoin crashes, shareholders will suffer severe losses. Okay, so maybe that's what he's referring to here. This is true. If Bitcoin crashes, the common stock shareholders will have severe losses as well, probably higher than the Bitcoin drawdown. So if Bitcoin goes down 50%, MSTR will probably go down a lot more than 50% because it's a leveraged Bitcoin play. But it doesn't mean it will go to zero. And we'll get back to it later, but I think this is true concerning the common stock, so MSTR, but it's not necessarily true for all of the preferreds, including Stretch, Strikes, Stride, and Strike. But more to that later. Yet people keep buying. I explain. Stretch is the latest trick. First came convertible bonds, hedge funds loved it, 60% implied vol, 120% realized vol, pure damage rate. Okay. Then Strike, 8% fixed yield, convertible, Strive, 10% fixed yield, non-convertible, then Stride, another 10% non-cumulative. Okay, so here, a major misconception and something that is really important to understand on those preferreds. It's just factually incorrect what is written here. Strike, Strive, and Stride, they don't have a fixed percentage yield. Very important. they have a fixed dollar amount yield. So Strike, it's not 8%, it's $8 per year. Strife, it's $10 per year. So what does this mean? It means that if those preferreds increase in value, the underlying stock increases in value. So Strike doesn't trade at $100, but it trades at $200. Then the dividend is still $8 a year. So Strategy is able to issue the share at $200 and has to pay $8 per year in dividends. So the yield is actually 4%. Very important to make this distinction. So it means that as those preferreds accrue in value, Strategy is able to emit those preferreds at a better term for them. So the higher the price of those preferreds go, the less actual percentage yield that they have to give, because the yield is fixed in dollar terms. So this is one advantage that they have. If the price of those preferreds go up, they get more favorable terms. Now, almost more important is the second point, is that if those preferreds go down in value, the yield is still fixed at those dollar values as well. So if Strike goes down to $80, the yield is 10%. If Strike goes down to $40, the yield is 20%. So this is what we mean when we say that those instruments are self-healing, or Ben Workman has coined this term of self-healing, is that if the price of the preferreds crashes, the yields become more and more attractive. And at some point, they will get bought up by the market participants because the yield is just too attractive to pass on them. So there is actually a floor on those preferreds, and they will not go down as much as the common equity, because the yields just become too attractive at some point. And even in a bear market, yield-starved investors will want to buy those instruments because maybe the risk they will perceive is higher, but also the yield is a lot higher. And this is not different than going out on the risk curve in the fixed income market. You can buy loans that are investment grade, but you can also buy high yield equivalents like junk bonds, basically, which are more risky but also give you a higher dividend. And there's a market for that. And if the price of those preferreds crash because the risk becomes high, because Bitcoin goes down, because the people trust Strategy less in a bear market, those instruments will become more attractive and a floor will be put on them. So very important to understand, and this is what Anton here is getting wrong, is we don't have fixed yields at a certain percentage. It's fixed in dollar terms. That's why if it goes up, it's good for Strategy. They can issue at more favorable terms. And if it goes down, it's also good for Strategy because there is a floor on those instruments, and they will get bought up at some point and not crash to zero. Okay, so let's continue. Now, Stretch 9% monthly yield can change every 30 days. Factually true. All sold to retail, none generate real income. Okay, so I don't know where this is coming from. I think this is speculation. All sold to retail. I mean, they have an initial offering of 500 million. This is definitely not going to retail. This is being sold to accredited and to institutions. Once it trades on the Nasdaq, then retail will be able to buy it. True, but I don't think retail is the only customer here. I mean, anyone, any institution, any hedge fund looking for fixed income is a potential buyer of this instrument. So I don't really get where this comment comes from that it's only retail. And non-generate real income, again, the premise here is that they buy Bitcoin with the proceeds and Bitcoin goes up over time. So there's your income. No cash flows, no products, no services. Again, not true. No cash flow. Yeah, it's not a cash flow generating business except the core business of Strategy, but their huge treasury in Bitcoin has an ARR of 50% per year currently and is expected to come down, but down to 30%. So it's still, their value is still increasing year after year. If you believe in Bitcoin, you can say, okay, not directly cash flows, but there is value accretion to Strategy holders. And no product and services, it's just wrong. I mean, the products and services that Strategy is offering are those financial products. They're bringing products to market in a world starved for yield. They're bringing out products that actually give you a yield and a very attractive yield at that. So that's their products and services. It's the financial instruments that they emit to service the market, to attack the money market funds, but also the bond market and all of that. So those preferreds are actually their products and services. Second, this is not a Bitcoin investment. Retail buys Strategy thinking they're buying BTC exposure. You're not. You're buying leveraged Bitcoin derivative backed by high yield debt, traded at premium MNAV over 1.8. Okay, and I agree with that point, actually. It's true. If you really just want your Bitcoin exposure, the best thing to do is to buy Bitcoin, cold storage, your keys, your coins. I agree with that. Now, if you want a leveraged Bitcoin play, I also agree with that. It's a leveraged Bitcoin play. So if you want more accretion than Bitcoin has, you can buy Strategy. But it also means that to the downside, you will have more losses. I agree with that. Now, backed by high yield debt, not really. It's backed by the Bitcoin they hold on their balance sheet. And they have some debt, but it's not high yield. I mean, they have some convertible bonds. I think their average interest payments on that is less than 1%. And then they have those preferreds. Obviously, there the percentage is higher. But again, as the price of those increases and they emit more, the actual yield will come down. And we have to put this in perspective. And here it's good to show the slide from Strategy's last presentation is how much debt are we even talking about, right? So you see they have $72 billion worth of Bitcoin on their balance sheet. Now, there's $5 billion of debt that they have that we can reduce from that. So we're down to $67 billion worth of Bitcoin on their balance sheet. And then you look at their liabilities that they have for the interest payments. So it's $370 million per year that they have to pay out for the dividends of the four preferred instruments that they have. Now, to mention here is that for Stride they don't have to pay those dividends. So in a worst case scenario, they could also decide to reduce those 370 million by the orange portion here that you see. And for the others, they can decide to withhold the dividend payments for a certain period. Then, of course, they have to pay it back later on the other instruments. But they could theoretically bring that down to zero for a certain period of time and then pay back later when the market is in better conditions, right? But let's assume they couldn't do that. They have to pay 370 million per year. They have 67 billion on their balance sheet. So as of today, if Bitcoin just stays flat, they could pay those dividends for the next 180 years. Okay, but now the argument is what happens if Bitcoin goes down? So okay, let's look at that. If Bitcoin goes down by 75%, of course, this 67 billion melts by 75%, and they're left with around 16 billion worth of Bitcoin. But still, they're able for the next 26 years to pay those dividends. So if Bitcoin crashes by 75% and stays there for 25 years, they're still fine. Right, so it's important to understand what are we even talking about in terms of risks here and over leverage, and it's just not true that they have too much debt. Now let's get back to the article. When Bitcoin drops, BTC price collapses. Agree. Strategy stock collapses. Agree. Premium collapses. Retail will get crushed twice. Absolutely agree with that. And this is the thing you need to understand when you invest in MSTR, in the common stock. It's great when Bitcoin goes up because it's a leveraged Bitcoin play, so it will most likely go up more than Bitcoin. But if and when Bitcoin goes down, of course, the MSTR stock will get crushed as well, and more than Bitcoin, because as he correctly points out here, the stock is trading at a premium, 1.8 MNAV, and what probably happens in a bear market is Bitcoin goes down in price, and the MNAV at the same time compresses down towards 1. So you have the double impact if you're holding the stock. And again, it's a leveraged play. So if Bitcoin goes down 50%, probably MSTR goes down 75%. So this is true. And this is what you need to know if you invest in the common stock. But again, I don't think this applies to the preferred shares, because there the risk is a bit different and you have this floor due to the high yields. So continuing. The endgame is simple. It isn't a mystery. Crash is baked in. Seller raises billions, buys Bitcoin, sells yield products to fund old ones. Okay, misconception here. They don't need to sell new products to fund the old ones. They have their operating business that generates cash flow that they can tap into to pay those dividends. They can decide to withhold dividend payments if the market environment is not very good. They can issue the common stock to pay those dividends, or they can issue the additional preferred, which is what he's referring to here. In a worst case scenario, they can also sell Bitcoin to pay those dividend yields. That's what we saw before, right? That they could pay the dividend payments for the next 180 years if they sold the Bitcoin for it. So not necessarily. It will just depend on the market environment, and if there's a lot of demand for those additional preferreds, they will issue preferreds to pay the dividends. And if there's no demand, or if something else is more accretive at that moment, they will do something else. So they have a lot of options to pay those dividends. So this point is just not true. If BTC falls, yields become unaffordable. We just saw before in the overview, Bitcoin can fall 75%. The yields are still affordable. They can pay them for 20 years. So if you don't believe that Bitcoin falls and stays low for 26 years, we're fine. Retail panic sells MSTR and STR, so all of the preferreds. Premium dies, MNAV goes to 1 or lower, liquidity vanishes. So I agree partially. Retail might panic sell MSTR. Again, the common stock will be the most affected by a drop in Bitcoin. Again, on the preferreds, don't agree. There's a yield denominated in dollars. If it goes down too much, it will get bought back up by yield-starved investors. Premium dies, I agree with that, and MNAV will get compressed. I don't know if it will go all the way down to 1 or lower. We've seen in the last bear market it was actually below 1, but the risk of Strategy was a lot higher then because they had some debt collateralized by the Bitcoin that they held. So there was a risk of a margin call in the last bear market. This is why it probably traded below 1, because there was a risk of MSTR collapsing at the time. Now, with their debt structure that they have today, I don't think it's really reasonable to have an MNAV below 1, but definitely lower than it is today. It could happen and probably will if Bitcoin crashes. And liquidity vanishes, yeah, I agree. Today, Strategy is issuing 500 million worth of stock a week and buying Bitcoin with it. And in the depth of a bear market, they won't be able to do that. That's pretty clear to me. There won't be any liquidity to add additional Bitcoin. But the only thing this means is that they will just lay back, hold, and when the market gets better again, they will continue their operations. Sales pyramid collapses. I think we have debunked that by now, that it's not the pyramid scheme, and that they have a lot of different ways to pay. Okay, so moving on. We are seeing the biggest bubble in the cycle, worse than altcoins, worse than yield farms, worse than meme coins, because it's designed to look safe, because it's dressed up in legacy finance language, because it's being sold to institutions and boomers who don't get it. I mean, I don't know what he's saying here, because before it was all retail, and now he's talking about institutions and boomers not getting it. If you want to buy if you want Bitcoin exposure, buy Bitcoin. Fully agree with that. Again, if MSTR is not for everyone and the volatility is big, I mean, the volatility of Bitcoin is already large, and then you have a leveraged Bitcoin play on top of it. So yeah, of course, it's not for everyone. And if you just want Bitcoin exposure, the safest bet is to just buy and hold Bitcoin. Fully agree here. Don't buy leveraged yield wrapper structured like convertible debt pyramids. Okay, I think we debunked that. Definitely don't buy one that needs a monthly dividend adjustment mechanism to stabilize its price. I mean, I don't know what the criticism is here, because they have 4 different preferreds. One is designed to have a stable price, because it's a different market that they're after, right? They have 3 other preferred shares that are going after the bond market, and they have this new one where they're going after the money market funds. This we can see it here on the short duration credit assets that they're going after with the stretch. It's all the USD bank accounts, money market funds, short-term treasuries, some commercial papers, and stable coins. And they just offer more attractive yields for all of those pools of capital. And the important thing to be able to get capital flowing into Strategy is to have a product that is stable in USD price to be able to tap those markets, right? So yeah, I don't know what the criticism is here. They need a stable product if they want to get into those markets as well. Seller is not building a company, he's building a structured product machine. Yes, true. Financial engineering at its finest, and he will keep going, and maybe some of those products will work, others won't, but I don't think they will stop their financial innovation here. So just to recap, I think if you want to summarize all of this into a few sentences is, if you believe Bitcoin is going to zero, Strategy is toast. If you believe Bitcoin is going down by 80%, and staying down for the next 2-3 decades, Strategy is also toast. In any other scenario, Strategy will be fine, because they are not over-leveraged. They have many different ways to pay dividends. They sit on 72 billion worth of Bitcoin today. So if we have a traditional bear market, as we've had in the last 3 cycles, Bitcoin going down 80%, of course, the common stock will suffer. The preferreds will suffer as well, probably less. And then Bitcoin will come back and will hit a new all-time high, and Strategy will be fine. And in the bear market, they won't be able to accumulate Bitcoin at the pace that they're doing it now, but they will not collapse unless Bitcoin goes down 95% plus and stays down for many years. Any other scenario? Just look at the numbers, look at their debt levels, look at the liabilities that they have from those preferreds, and you'll see that most of the arguments that you see here are just not correct. I also want to mention a lot of comments below this post are talking about this scheme just working as long as Bitcoin's price stays above Strategy's average purchase price, which is around $71,000 a coin currently. And this is also absolutely wrong. Bitcoin can go below 70K, it can go below 50K, it can go below 30K, and Strategy is still fine. So I don't know where this is coming from. It's just wrong. So let me know what you think about this, and let me know if you liked this type of content. Again, none of what you heard is financial advice. Do your own research. And if you don't like volatility, don't invest in any of the products we talked about today. Bye, everybody.
How many chairs are you sitting on right now?